The American economy just got a wake-up call, one that echoed through boardrooms, trading floors, and factory lines across the country. And it came from Ford, one of the country's most iconic companies, a symbol of American industry and resilience for over a century. In May 2025, Ford did something almost unthinkable for a company of its size. It slammed the brakes on its financial forecasts. The message was blunt. We have no idea how much money we're going to make this year, but it's going to be a lot less than anyone hoped. The reason? New tariffs imposed by the Trump administration, set to carve a staggering $1.5 billion hole in Ford's earnings. These weren't just numbers on a spreadsheet. This was real money, real jobs, and real consequences. This wasn't about bad cars or poor management. It was a government policy hitting their global supply chain like a sledgehammer, disrupting the delicate balance that keeps factories running and workers employed. Ford's stock tanked, sending a clear warning to the entire auto industry. A major breakdown was imminent. The timing was brutal, coming just as the company was trying to reinvent itself for a new era. Ford had just beaten analyst expectations for Q1, despite the costly transition to electric vehicles, a move that was supposed to secure its future, not threaten it. Suddenly, all that planning, all those late nights and strategic bets were thrown into chaos. Executives scrambled to make sense of the new reality, while employees wondered what would come next. The tariffs introduced a level of uncertainty no company could have prepared for. Supply chains that once ran like clockwork now faced delays, shortages, and skyrocketing costs. Ford's move to pull its financial guidance was a dramatic admission, an acknowledgement that the economic landscape had changed overnight, and that even the biggest players were suddenly flying blind. This wasn't just about Ford's bottom line. It was the opening chapter of a much larger economic crisis, one that threatened to ripple through every corner of American manufacturing. The stage was set for a showdown between automakers and their own government, with American consumers, workers, and communities caught in the crossfire, anxiously awaiting the fallout. The warning was clear. This was just the beginning of a storm that could reshape the entire industry, and perhaps the nation's economic future. To understand Ford's crisis, we have to rewind and examine the political and economic forces that set the stage for this upheaval. Ford, like many American automakers, has always been deeply intertwined with global trade, relying on a complex web of suppliers and markets that stretch far beyond US borders. The spark that ignited this turmoil was a single sweeping policy decision, one that would send shockwaves through the entire industry. In March 2025, the Trump administration unleashed sweeping tariffs, 25% on nearly all imports from Canada and Mexico, and an extra 10% on Chinese goods. These tariffs were broader and more aggressive than anything seen in decades, targeting the very lifelines of American manufacturing. The official reason? To fight fentanyl, despite mounting evidence that public health efforts, not trade barriers, were actually reducing overdose deaths. Many experts questioned whether tariffs could ever address such a complex crisis. Critics saw it as a political move, using a public health crisis to justify a protectionist agenda. The debate raged on cable news and in the streets, with many accusing the administration of exploiting tragedy for economic gain. These tariffs were the realization of Trump's America First doctrine. Trade as a zero-sum game, where every foreign gain was seen as an American loss. The message was clear: protect US jobs at any cost, even if it meant risking economic stability. Automakers like Ford had warned for months that such policies would cripple their operations. Their warnings were ignored, dismissed as fear-mongering or resistance to change. The result? Chaos. Stock markets plunged, with the Dow dropping over 1,300 points in a single day. Investors scrambled to make sense of the new reality, as uncertainty rippled through every sector. The message from Wall Street and beyond was clear. This was reckless, threatening decades of integrated supply chains and the economic stability that came with them. Business leaders warned of long-term damage. The auto industry was bracing for impact, powerless to stop the wave. Workers, executives, and communities across the country waited anxiously, knowing the shockwave had only just begun. Tariffs don't just disappear, they get passed on. For the US auto industry, the new tariffs meant a $100 billion bill in 2025 alone. Ford's share? $2.5 billion. That's money not spent on innovation, jobs, or competing globally. The most immediate effect: higher prices for consumers. A 25% tariff could add up to $6,000 to a new car. Suddenly, basic transportation is out of reach for millions. Worse, job losses loom. Up to 367,000 auto jobs could vanish, from assembly lines to dealerships. The policy meant to protect American jobs could become a job killer. Higher prices mean lower demand, which means fewer cars sold and layoffs. The tariffs, meant to shield American industry, have put it in peril. In a global economy, there's no such thing as a simple trade war. Everyone pays the price. Ford didn't just accept its fate, it got creative. When faced with a sudden and punishing tariff landscape, the company's leadership knew they had to think outside the box to keep their business running and their workers employed. With 79% of its US sales assembled domestically, Ford had a buffer. This strong American manufacturing base gave Ford some breathing room, allowing it to weather the initial shock better than some competitors. But it still relied on parts and vehicles from Mexico and Canada. The North American supply chain is deeply interconnected, and even a company as established as Ford can't simply cut ties overnight. To dodge the 25% tariff on Mexican imports, Ford rerouted vehicles through Canada using special carriers, a workaround that could save $1 billion. This logistical sleight of hand required careful coordination and a willingness to adapt on the fly. It's a bizarre reality, an American company shipping cars around the US to avoid US taxes. The irony isn't lost on anyone. Ford's trucks and SUVs, icons of American roads, now take detours just to reach their own dealerships. But this fix adds cost and complexity, and doesn't solve the problem of tariffs on imported parts. Every extra mile driven, every new route mapped, chips away at Ford's bottom line. Every engine or wiring harness crossing the border now comes with a hefty tax, raising costs even for American-made vehicles. The ripple effect is felt throughout the supply chain, from suppliers to showrooms. Ford's scramble is a masterclass in adaptation under pressure. Teams work late into the night, brainstorming new routes, negotiating with suppliers, and rethinking logistics at every turn. But these are short-term fixes, not a long-term plan. The company knows it can't keep patching holes forever, and uncertainty looms over every decision. The company is walking a tightrope, balancing immediate survival with future health. Every move is a gamble, and the stakes couldn't be higher for Ford's workers and shareholders. The tariffs have forced Ford to go out of its way just to do business at home. What once was a straightforward process is now a logistical maze, with new obstacles at every turn. It's a desperate, unsustainable scramble. The disruption is profound, affecting not just Ford, but the entire American auto industry. Ford's ingenuity can only go so far. In the end, the company's future may depend on more than clever workarounds. It may require a fundamental shift in how cars are built and sold in America. Ford isn't alone. Detroit's Big Three are all in crisis. GM slashed its profit forecast, warning of a $5 billion hit from tariffs. Only 53% of its US sales are domestically assembled, making it even more exposed. Stellantis suspended its financial guidance entirely, joining Ford in admitting it can't predict the future. The industry is flying blind, its business model, efficient cross-border supply chains, shattered. CEOs warn that costs can't be absorbed, prices will rise, jobs are at risk. The idea that tariffs punish only foreign countries is a dangerous fantasy. The auto industry is global, and now, it's in survival mode. America's trading partners didn't take the tariffs lying down. Canada's Prime Minister called them very dumb, accusing the US of economic sabotage. Mexico and China hit back with their own tariffs, targeting American exports from soybeans to cars. The result, a full-blown trade war, with allies turning into adversaries. For companies like Ford, this means higher costs to import parts and new barriers to selling American-made products abroad. The fallout is global strained alliances, lost markets, and diminished US influence. The America First policy has left America standing alone. Economic actions have diplomatic consequences. The fire is now burning far beyond America's borders. All these costs end up in one place, your wallet. New car prices are set to rise by thousands, putting ownership out of reach for many. After the tariffs, dealerships saw a brief sales rush, consumers scrambling to buy before prices soared. But the boom was short-lived. The real impact is a market chilled by high prices and uncertainty. Retaliatory tariffs mean higher prices on everything from lumber to electronics to avocados. Even gas prices are affected, as global trade disruptions ripple through energy markets. Wages aren't rising, but costs are. For many, it means tough choices. Delay a car purchase, cut back on essentials. The trade war, meant to help Americans, is making life more expensive for everyone. The tariff fallout has sparked a chorus of conflicting voices. Ford's CEO warns of price hikes and job cuts, while the United Auto Workers Union surprisingly supports the tariffs, hoping to protect American jobs. This creates a tense dynamic. Unions back a policy that could threaten their own members' jobs. The Trump administration remains defiant, dismissing industry concerns as fear-mongering. Allies like Canada call the tariffs reckless and self-destructive. CEOs warn of disaster, unions cheer protectionism, politicians double down, and allies cry foul. There's no consensus, just mounting economic damage. The nation is divided, unable to agree on the crisis even as the pain spreads. The house is on fire, but no one can agree on how to put it out. As the dust settles, the future for Ford and the American auto industry is deeply uncertain. Ford's electric vehicle division is already losing billions. Tariffs add more pain, forcing cuts to innovation and jobs. If tariffs persist, companies may have to rebuild supply chains at enormous cost or shift production overseas. Ironically, America First could shrink the US auto industry. For workers and families, the outlook is grim job losses, higher prices, and a broken social contract. The longer the trade war drags on, the deeper the scars, potentially triggering a broader recession. Ford's crisis is a cautionary tale about protectionism in a global world. The only certainty: American workers and consumers will feel every bump on the road ahead.